you can't put all of your money in the stock market, and you can't put all your money into cash or annuities or something that's an alternative investment to the stock market and bonds. So what we try to do is strike a balance and see what that looks like.
Once again, we are here with Tim Stearns, CFP, founder at TJ Stearns, Inc., a resource for proactive Chicagoland area savers and investors. We have been reviewing the new book by Tony Robbins, The Holy Grail of Investing. Now, Tim, so far we've been summarizing the book, hitting on the highlights of the subject matter discussed. I like to give a little case study. So let's say that an investor walked into the office there at TJ Stearns, Inc., and in our hypothetical scenario, they're 55 years old, married, planning to retire in maybe 10 years. That puts them around traditional retirement age of 65. The couple combined have assets of about $4 million spread across a mix of retirement accounts and brokerage accounts, maybe a few real estate investments. No major debts. They understand their income, and their main goal or concern is that they want their retirement to be secure and confident with a steady stream of income that won't run out. They also, obviously, as we all do, have concerns about taxes eating away at their savings, and especially potential changes in tax laws into future years. So I finally want to make sure that their estate plan is solid and that they leave a positive legacy to their children, not to the IRS. They don't want Uncle Sam to be their largest beneficiary. What would you help this couple work through, understand, and then what is the process for analysis and implementation there at TJ Stearns, Inc.?
Well, the first thing we'd want to do is get to know each other, and figure out exactly what all that you just said is. There's a lot of minutia underneath that. I've had people say, "Oh, I have stocks and bonds," and it turns out most of the money is in cash or something like that. So we'd want to really, really dig deep into what they have going on and what their investments are. We're seeing a lot of people in that age group who have a good substantial amount of assets. And fortunately or unfortunately, most of it's built up in their 401ks and that type of thing. And it's never been taxed by Uncle Sam. So one of the things we would sit down with them, kind of go over and do a discovery, we call it. And then if we choose to engage from there, we would actually go and dig into their statements and their actual investments. And then more importantly, we'd ascertain kind of what their risk level is. A 55-year-old is not much older than me. And so I know where they're at, but I'm seeing a lot of people who feel like they need to play catch up, or that the market's hot, which you kind of have to get away from playing those games when you get to be in your 50s, because you need to, retain what you've made. So we would sit down with them. If we choose to engage, we'd really dissect what they have going on as a portfolio. And then I'd want to know, what do you want to do? What is your goals? They want to leave something to their kids, but what does their retirement look like? And that's another ball of wax, because you want to make sure that both the husband and wife are on the same team. I've had 1 million people come in our office and say, "Oh, I want to move to Florida, or I want to get out of here," or whatever. And the wife or husband looks over and says, "Well, our grandkids are here. I'm not going anywhere." So you got to have those conversations.
Align your vision of retirement, and then align your portfolio and your investments to go along with that vision and those goals. Tim, you've named your process the Protect and Grow plan. Can you talk to us about, maybe, as Tony Robbins discusses in his book, behavioral psychology? Given behavioral psychology and then an individual specific situation, what is the balance? How do you strike the right approach between those two different parts to the plan, the protection and then the opportunity and the growth?
Well, you can't put all of your money in the stock market, and you can't put all your money into cash or annuities or something that's an alternative investment to the stock market and bonds. So what we try to do is strike a balance and see what that looks like. So protect and grow literally means we're going to try to protect most of the money, and then we also need to grow it. My mom is 94. She'll be 95 in December. Even with her, she still has money in the stock market, because how else will I keep up with inflation, right? So one of the things that we'll do is we'll make sure that we have a balance of the money that's protected. Maybe it goes into an annuity. Maybe it goes into one of our dividend plus funds. But either way, they know that they're going to have protection and the money is going to be coming in as an income each month. The second part of that is obviously we need to grow it. And so when we manage money, we try to have active strategic management of that money, having stop losses, having covered calls. We do a lot of different things that I think a lot of places don't do. So that's really important to me.
And Tim, the rest of it is the protect and grow written retirement income plan that goes along with that as well. And I know Tony in his book talks a lot about securing retirement income. That reliable retirement income stream for retirement, even with our theoretical hypothetical couple with $4 million, would need to document their plan for generating income in retirement. Can you talk to us about why and how that leads to overall effectiveness?
Well, one of the things I'm really excited about right now is with interest rates being so high, we can do a lot more with money than we could, even 2 or 3 years ago. So we're looking at annuities that are doing, roll-ups, which means the money's growing at a certain level each year for their income. That's a guarantee from the insurance company. So those are the things that we look for our clients to get them into a product that's going to pay the bills every month, rain or shine, doesn't matter what the stock market's doing. And it's been proven that that's a better way to go about it for their psyche, that they're going to be okay because they know that the market, they don't care about that. They know the bills are being paid. And then the other side of it would be the growth, which is, we're going to have stop losses and that type of thing. We're not going to be perfect, but we're going to be a lot more active and hands-on than they're currently.
Where there is growth, where there is income, Tim, there's taxes that go along with those things. How would you help this hypothetical couple plan to mitigate and to address the tax liability that they have?
Well, it's funny you ask about that. We have added in the last year a tax report that we do to show people that if you have, say 2 million in IRAs and 401ks and that type of thing, what kind of a tax bill you're going to be looking at. And that's an eye opener because, people, it breaks it down into 3 areas. Number one, what they'll be paying. Number two, what they might be paying again if they reinvest it. And then the third part is what they're going to leave as a tax bill to their beneficiaries, which a lot of times is their kids. So we do that report for them and then say to them, now, do you want to fix that? Do you want to do some Roth conversions? Do you want to do some things that would be an alternative to having that huge tax bill? And I've never had anyone say no.
Where does insurance and estate planning play into this review process or this hypothetical couple's picture? They aren't quite retirement age yet. Do both of those play in?
Oh, absolutely. With the insurance, a lot of times what we can do is, take some money and start putting it in a life insurance policy that would help with some of those taxes that are going to be out there. But obviously we're also looking at Roth conversions too, because the current tax bill is going to expire at the end of 2025. So we need to take advantage of these low tax rates that we have not seen since the 1980s.
With $4 million today, Tim, I've got to imagine 10 more years of work time horizon. They're going to keep contributing. They're going to keep growing. They're going to have more money into the future. In the meantime, current estate tax levels are remarkably high, but those are potentially subject to some pretty drastic changes. So while they may not be in a place where estate taxes are a big deal quite yet, if they do get growth, if those laws change at all, if they've got enough time for the money to build and grow, and if they keep contributing, certainly estate taxes could be an issue into the future. And then for those retirement accounts, it's income tax before estate taxes is even relevant.
Yeah, Peter, what you're talking about there is the estate tax, which is going to also sunset at the end of 2025. And right now, you can leave about $27 million estate tax free to your heirs, but that will sunset and go back down to 5 million at the end of 2025. So what are you doing to fix that? And I do see that happening. I could see it even going lower. So we need to figure that out. And estate planning comes into this. And thankfully, we have an attorney on staff that helps with that. So those are the things that we're obviously focused on with people when they're talking about, they want to leave their money to their kids, not to Uncle Sam.
And Tim, when we structure a plan, no matter how well thought through, no matter how secure, no matter how well laid it is, on the day that we implement it, our lives change, the world changes around us. Tony, in his book, talks about the need for an ongoing process of planning. How often are plans reviewed and adjusted there at TJ Stearns Inc.?
Well, once we do a protect and grow plan, we are going to focus on making sure that we're on task. And so we meet at least once a year with people. Life comes at us pretty fast. So, if they had something happen that's drastic, losing a job has been a thing in the last couple of years because of COVID and that, or quitting, their job. But either way, the rules of the game of engagement have changed. So we have to figure that out. So we meet with people and see, looking at the roadmap, where are we, where we thought we were going to be. We just had a couple in the other day, and she was overjoyed that she was over $500,000 better than where she thought they were. So it's not because we found money, it's because she didn't realize how well that we were doing.
Well, Tim, it sounds like you and your team there at TJ Stearns do a pretty comprehensive job in planning and helping people grow and protect assets, and looking at the tax implications and costs and liability, looking at planning effectively for healthcare, as well as making sure the family is taken care of, estate planning part of that. I can see how that kind of level of detail gives a lot of peace of mind and confidence for somebody moving into or approaching retirement.
The one thing that we're seeing, Peter, is people want peace of mind, and not having a plan is defaulting to a plan, which is just going to take what comes at you. I don't think that leads to a good retirement. So when we're meeting with people, they are overjoyed that we show them, this is how you're going to pay your bills the next 30 plus years. And if something happens to you, John or Mary, this is how we're going to go forward with the other side of it when you're, by yourself. So everything that goes into that and is baked into that is dynamic, so that if we need to change things, we can do that. But I've noticed with baby boomers, especially, they are so happy to finally have a plan.
All right, Tim, well, let's get into some common questions and answers, and even a few that get submitted along the way. One of the common ones, Tim, is somebody has already been working with someone. I already have an advisor or money manager. So what is the difference between what they do and the job that you and your team do there at TJ Stearns? What could you do for me that is different?
Well, most of the plans that we're seeing that people have done with other advisors are pretty cookie cutter. They come in, and I've always wanted to see if I ran with an East Coast, Midwest, and West Coast advisor, what their plans would look like for, let's say, John and Mary, who have $4 million assets. And I would bet with these bigger box companies, it'd look all the same. They're using mutual funds. They're and a lot of times it's proprietary. So within the name of the company being used as their mutual funds, I don't see that as being looking out for your client that well. So one of the things that we try to pride ourselves on is that everyone's different, and you need to make sure that they feel comfortable and that you're serving them and not having a cookie cutter process.
And Tim, most people need more than just exposure and access to a family of mutual funds. That's access to a powerful investment tool or investment option, but that's not true comprehensive planning.
No, it's not. I mean, I see these people who are literally just money managers. And to me, that's not being an advisor. That's in fact, defaulting to just the old days where it was stocks and bonds. What does Tony Robbins talk about in his book? That Ray Dalio, one of the largest hedge fund managers in the world, said you have to have alternative investments. And what are those alternative investments? They can be, commodities. They could be private equity. They could be annuities. Even CDs and that type of thing. But having things that are not correlated to the market. We're seeing people come in here, they have only two things: stocks and bonds. And guess what? Nowadays, those are correlated.
Tim, another common question here, and something that we've heard, these strategies sound great, but how do I know if they're right for me in my situation? How do I know if they're a good fit?
A lot of people, don't know what they don't know. So when we sit down with someone, we're very detailed in the first meeting to figure out exactly what they're looking for and if we can help them. And in most cases, we find that they have a glaring hole. It might be estate planning. It might be they've never even really thought about taxes. It might be they're not diversified, but they do have holes. And, we're going to have to, we press on those pressure points because we want to make sure that they understand, hey, John and Mary, you're not as well as you thought you were because you have not done X, Y, or Z, and we can help you with that.
What would it mean to a person, Tim, if they found out years down the road that the investments were not aligned with their goals and their needs and their time horizon? I'm sure that would be of concern and that they would want to know that sooner rather than later. So evaluating if your investments are a fit or not is, again, an ongoing proactive process all along the way.
Right. You need to know what's baked into your portfolio. So we explain to people, we'll go through it in detail, how much risk they have, what they have in there, that when this went down, so did this go down. A lot of people are in this false hope that if you have stocks and bonds, you're diversified, and that's not it. And Tony Robbins talks about that. And so we pride ourselves at TJ Stearns by doing different things for our clients, getting them alternatives that aren't tied to the market.
Tim, Tony also talked about fees and investment costs. It's a common concern. What are the fees? Question, how can we find out how much the access to the tools and the management of our money is actually costing us?
Okay, so what we normally do is we have our client fill out an application that has all of our fees, full disclosure right there in writing. But what I see with a lot of other advisors' plans when they come in here, this client or that client thinks they're only paying 1% to the advisor. And what they don't realize is that with the mutual funds underlying it, they're also paying for those mutual funds and those money managers. So kind of a round trip of fees. And the other phenomenon we have seen now is this thing called, reverse churning, which is literally the phenomenon that of advisors not doing anything to earn their money, not trading, not doing anything, not restructuring, rebalancing, nothing. And we see that over and over, and we point this out to the client. You lost over 20-something% in 2022, and you had 3 trades done, and they were dividend reinvestment. What is this person doing for you? And how can you perform better by getting into active strategic money management?
Tune into Chicagoland certified financial planner Tim Stearns' full radio program and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Investment advisory services offered through Cornerstone Securities, LLC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals or growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.